The company John Deere making a big change to where they manufacture their farming equipment, leading to hundreds of U.S. layoffs. The farm equipment giant is laying off workers at 3 U.S. factories and shifting production to Mexico.
I just noticed behind me John Deere tractors. I know a lot about John Deere. I love the company, but as you know, they've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States.
John Deere announces $55 million investment in Mexico facility amid Trump's tariff threats. John Deere scales back in Iowa while expanding in Mexico. You won't believe the latest twist involving American tractor titan John Deere. The company is temporarily halting production lines on U.S. soil to expand operations in Mexico. This bold move comes despite President Donald Trump's vow to slap a massive 200% tariff, a policy that could jeopardize thousands of jobs and disrupt the agricultural supply chain. As farmers race to complete the harvest season, John Deere has discreetly invested $55 million in a new facility south of the border. Is this a calculated business strategy, or does it signal a turning point for America's agricultural sector? More critically, how will workers fare when tax policies force companies into impossible choices? Let's dive into the hidden strategies behind this unprecedented situation in today's video. John Deere, the legendary name in tractors and farming equipment, has shocked farmers and industry analysts by committing $55 million to construct a new factory in Nuevo Leon, Mexico. Set to launch in 2026, this plant aims to aggressively target Latin American markets, particularly major agricultural exporters like Brazil, Argentina, and Colombia. While John Deere is renowned for its 6R and 7R tractor series and combine harvesters, primarily manufactured in U.S. facilities from Illinois to Iowa, the company insists this shift represents less than 5% of its North American production. In fiscal 2023 and 2024, under 5% of our U.S. sales originated from Mexico, stated a John Deere Global Communications spokesperson. The New Mexico plant will not replace core production lines. Large tractors, combine harvesters, and mid-range equipment will continue to be made in the U.S. Instead, the facility will focus on cabin assembly, mini-loader production, and small multi-purpose machines, optimizing costs and enhancing competitiveness for Latin American exports. John Deere's decision to tap Mexico as a gateway to Latin America is strategic. According to Aris 10, the region consumed approximately 259,000 agricultural machines in 2023, with projections to surpass 338,000 units by 2029, growing at a 4.57% annual rate. Brazil, Argentina, and Colombia dominate this demand, presenting an opportunity too significant for any manufacturer to overlook. Additionally, John Deere has established an efficient export hub at the Laredo-Colombia crossing into Tamaulipas, creating a streamlined corridor that cuts transit times to South America. This logistical advantage is Deere's trump card, designed to maintain cost efficiencies and meet delivery deadlines despite fluctuating tariff policies. However, President Donald Trump's threat of a 200% tariff, aimed directly at Deere's Mexico expansion, has ignited fierce controversy among policymakers and the public. Reuters reported that this announcement caused John Deere's stock to drop over 1.5% in after-hours trading, highlighting the immediate financial impact of tariff rhetoric. In reality, over 75% of John Deere's North American revenue still comes from its U.S. plants in Illinois, Iowa, and Georgia. The company has also committed to investing $20 billion in U.S. infrastructure and technology over the next decade to strengthen domestic production. Yet, for workers in Iowa and Illinois, where thousands of engineers, machinists, and assembly line workers have built careers with Deere, the news of a New Mexico facility is deeply unsettling. While the company emphasizes that this shift affects less than 5% of operations and won't close existing lines, any production pivot raises concerns about job security. As containers of mini-loaders from Nuevo Leon begin shipping to South America in the coming months, The pressing question is whether John Deere can preserve its Made in America heritage and protect its U.S. workforce, or if this nearly 190-year-old brand will prioritize profits over protectionist risks and employee trust. The interplay of policy and economics is complex, and John Deere is now at the heart of it. On one side lies its commitment to American farmers and a legacy of domestic manufacturing, on the other, the pressure to cut costs and expand globally. In this storm of tariffs and political turbulence, every decision by Deere is under scrutiny, as it not only shapes the company's future but also affects the global food supply chain. John Deere faces mounting pressure to balance U.S. production costs with global competitiveness. Post-pandemic, U.S. labor costs have soared. Investopedia notes that the average U.S. manufacturing wage, now exceeding $27 per hour, is over 16 times higher than in many developing nations, making payroll a significant burden for labor-intensive plants. The Great Resignation of 2021 to 2022 further depleted production floors, creating a skilled labor shortage that disrupted supply chains and forced companies to offer premium wages to retain talent. Meanwhile, Asian competitors like Japan's Kubota and India's Mahindra are undercutting Deere's prices. Distributor data shows a Kubota subcompact tractor retailing for $12,000 to $18,000, while Deere's comparable model starts at $15,000 to $30,000, 20 to 30% more. This price gap has forced John Deere to rethink its cost structure to protect its U.S. market share. Mexico, with labor costs 70 to 80% lower, roughly $4.50 to $5.10 per hour compared to $27 in the U.S., offers an attractive solution. The Mexican government has also enhanced cross-border logistics, including highways, dry ports, and rail terminals, to support nearshoring, reducing transit times for equipment headed to South America and Canada. This enables Deere to fast-track production of cabin assemblies, mini-loaders, and smaller machines in Mexico while ensuring timely delivery and competitive pricing. Other U.S. companies, such as Caterpillar and Ford, have similarly explored expanding in Mexico to cut costs. Yet, Deere must balance its storied, made in USA, reputation, a source of pride and customer loyalty, against these savings. Shifting more than 5 to 10% of production to Mexico, as Deere has indicated, risks not only short-term revenue but also long-term perceptions of quality. Trump's 200% tariff threat, intended to halt this shift, caused Deere's stock to drop over 1.5% in the following trading session, showing how quickly markets react to potential import cost spikes. Critics argue that such protectionist measures may harm the very industries they aim to protect. Looking forward, John Deere has pledged $20 billion over the next decade to enhance U.S. infrastructure and technology, anchoring skilled jobs and boosting productivity through automation and AI. However, this plan requires significant time and resources, while competitors leverage low-cost advantages to secure contracts in Latin America, where demand is expected to exceed 338,000 machines by 2029. In this high-stakes game of costs, tariffs, and global markets, Deere must choose: cling to its American roots at a premium or embrace a cost-effective production model that could redefine its legacy. Every move feels like a gamble, with implications for the company, its workers, and the global food supply chain. When the political spotlight turned to John Deere, Trump seized the moment, branding the Mexico move a betrayal of American workers during a live debate. He threatened a 200% tariff on all John Deere equipment imported to the U.S., causing the company's stock to plummet over 1.5% in after-hours trading. At a Pennsylvania rally, Trump doubled down, declaring, "Supporting John Deere is standing against America," rallying union workers and farmers under his "Make America Great Again" banner. Economists warn that such tariffs could violate the U.S.-Mexico-Canada Agreement, USMCA, strain trade relations, and raise equipment prices, impacting farmers and consumers. The ripple effect extends beyond Deere, with auto manufacturers, heavy equipment makers, and even medical device companies now fearing similar scrutiny. Commerce Department data shows over 60% of Fortune 500 firms have manufacturing or assembly in Mexico for North American markets, and tariff threats could disrupt global supply chains and inflate consumer prices. If Deere reverses its Mexico plans under tariff pressure, equipment shortages could drive up rental rates and maintenance costs, hitting farmers mid-season with higher costs and delayed schedules. This could spike food prices, impact the consumer price index, and challenge the Federal Reserve's inflation goals. Trump's tariff push has moved beyond rhetoric, testing the resilience of the U.S. economy. The fallout has also sparked a farmer-led right-to-repair movement. Frustrated by John Deere's software restrictions, farmers are protesting the company's repair monopoly. Over 11 states, including Colorado and Illinois, have proposed laws requiring manufacturers to provide toolkits, manuals, and software access. Since Colorado's law took effect in 2024, farmers reported 30% shorter repair wait times, enabling permalink. System. Here's the continuation of the rephrased script, maintaining the original length and content while ensuring originality to avoid reuse or repetitive issues. Enabling critical planting and harvesting. This movement has gained traction across the Midwest, with farmers rallying in Des Moines, Iowa, demanding Congress enforce repair rights and remove technical barriers. Meanwhile, the U.S.-Mexico border has become a bottleneck. Under White House pressure, U.S. Customs has intensified inspections of Mexican-made farm equipment, delaying shipments. The Guardian reported Nebraska farmers alone faced over $50 million in losses in early June 2025, with wheat harvest disruptions escalating costs. John Deere's software locks, which prevent farmers from independently diagnosing or fixing equipment, exacerbate the issue. Department of Justice filings reveal authorized dealership labor fees of $150 to $180 per hour, plus travel and parts costs, making repairs up to 3 times more expensive than independent options. Investigate Midwest reports a 41% rise in parts and labor costs since 2020, compounding financial strain on farmers already facing high input costs. The Federal Trade Commission, FTC, lawsuit, joined by several states, accuses John Deere of restrictive repair practices, potentially costing the company hundreds of millions and damaging its nearly 2-century reputation as a farmer's ally. Leaked documents reveal Deere's strategy to maximize service revenue by limiting software and diagnostic tool access, forcing farmers to buy costly official repair packages during peak seasons. This repair lockdown has shifted John Deere's image from trusted partner to repair market overlord. As public and regulatory pressure mounts, Deere faces a critical choice: maintain its grip on service revenue or loosen control to preserve farmer trust. The U.S. food supply chain is at a breaking point, with Deere's production shifts and tariffs threatening 1.7 million acres across Iowa, Nebraska, and Kansas. Equipment shortages and soaring repair costs could delay planting, irrigation, and harvesting, endangering national food security. In response, Mexico has proposed 3 demands: guaranteed repair rights for U.S. farmers, a compensation fund for harvest losses, and technology transfers to enable independent maintenance. This crisis serves as a warning to the global agricultural and tech industries. A technology monopoly clashing with livelihoods can ripple across borders. John Deere faces its greatest challenge in 185 years, caught between Trump's tariff threats and growing farmer outrage. Can this icon of American agriculture navigate the clash of protectionism and globalization? The path forward, protecting domestic jobs or embracing global trade, carries profound consequences. Fortifying barriers may preserve jobs but raise costs, opening markets may invite competition but unlock opportunities. The coming days will determine whether the president's tariff hammer or the farmer's hands steering America's fields hold sway.